Welcome to the Opening Bell Report.
If you are joining us today, you already know we aren't here to rehash the basic concepts.
Right. We assume you know the broad strokes of the electric vertical takeoff and landing sector, or eVTOL.
Exactly. You know what an air taxi is. So today we are looking squarely at the unit economics, the brutal capital requirements, and really the fundamental survival metrics of this space.
That's the environment right now is ruthless.
It is. We're basing today's discussion on a fascinating analysis report covering Archer Aviation, which trades under the ticker ACHR.
It's a really compelling case study.
Yeah, and our mission today, the core question we want to answer is this. How does a company with massive financial losses secure its future in one of the most speculative, capital-intensive tech sectors in the world?
I mean, that's the multi-billion-dollar question, because if you look at the landscape of the eVTOL industry right now, having a revolutionary aerodynamic profile just isn't enough.
Or a proprietary electric powertrain.
Right, none of that guarantees you anything. Survival in this sector is entirely dictated by one thing, and that is possessing the financial runway to reach the federal certification threshold.
The FAA green light.
Yes, that regulatory green light is the only milestone that actually matters. If your capital dries up before the FAA certifies your aircraft for a commercial flight, your intellectual property, all your engineering breakthroughs, they are essentially worthless.
Which brings us to this incredible paradox highlighted in the analysis report regarding Archer. Right now, the stock is trading around $6.52.
It's taken a significant haircut from its historical peak.
Right. And if you just glance at a standard stock screener, you might assume the momentum has completely stalled out.
You'd think they were on the ropes.
Exactly.
Yeah.
But when you dig into their recent filings, you find an absolute game changer. They are sitting on a massive $2 billion cash fortress.
Which is highly unusual. For a pre-revenue aerospace company, having a liquidity pool that deep is a massive anomaly.
Okay, let's unpack this. Because we need to balance that $2 billion war chest against the staggering realities of their R&D burn rate.
That's a heavy burn.
Very heavy. In fiscal year 2025, Archer posted a net loss of $618.2 million. And against that massive loss, they recorded a microscopic $300,000 in revenue.
Which, to be fair, is exactly the financial profile you'd expect. I mean, they are attempting to build a commercial airline and a mass production aerospace manufacturing facility at the exact same time.
Right. Those aren't cheap endeavors.
Not at all. Despite being pre-revenue, management actually executed what the analysis report calls a masterclass in capital preservation.
By aggressively raising capital when they could.
Exactly. Through direct offerings and strategic investments, they secured $1.8 billion in gross proceeds.
And why does this matter so much for you, the listener, trying to gauge market survival? It matters because Archer ended 2025 with $2 billion in total liquidity and only $0.1 billion in debt.
That ratio is the whole ballgame.
It eliminates immediate bankruptcy risk entirely.
Right. It provides the exact runway they need to fund the brutal R&D costs for their midnight aircraft. It allows them to push through that final stretch of FAA certification without resorting to toxic debt.
Especially in a high-interest macroeconomic environment. Taking on high-yield debt right now would destroy their future margins.
It would. But what's fascinating here is that there's absolutely no free lunch in the financial markets.
No, never.
That survival mechanism, building that $2 billion runway, it came at a very steep price.
Shareholder dilution.
Severe shareholder dilution.
Let's get into the specific numbers on that dilution because they are staggering. The outstanding share count skyrocketed. In fiscal year 2024, they had roughly 455 million shares. By the end of fiscal year 2025, that float was over 661 million shares.
It fundamentally alters the ownership structure. And the analysis report breaks down how this creates a really complex financial concept for retail investors, basically an optical illusion in their valuation metrics.
Right, looking at the earnings per share.
Yes. Archer's EPS artificially improved from negative $1.42 to negative 99 cents.
Which makes it look like they're losing less money.
Exactly. It looks like belt tightening. But it's purely because of the share dilution. The actual net loss widened. But because you are dividing that loss across over 661 million shares instead of 455 million, the per-share loss mathematically shrinks.
It's a great reminder to always check the absolute net income.
Always. Now, this dilution heavily impacts their valuation. While their market cap is currently $4.8 billion, you have to strip out that massive cash pile to see the real picture.
Right, which reveals an enterprise value of just $2.9 billion.
Which is much more reasonable. It tells us the market has aggressively priced in the penalty for all that dilution. But they haven't fully priced in the massive binary upside of actual commercialization.
Here's where it gets really interesting. because the analysis report introduces a direct comparison between Archer and its lead competitor, Joby Aviation.
Ticker JOBY.
Exactly. And Joby clearly has a head start in the early monetization race.
They do. Joby pulled in $53.4 million in fiscal year 2025 revenue.
Mostly fueled by early Department of Defense contracts.
Right. And that gives Joby a highly tangible growth trajectory. They are up a staggering 39,183% year over year.
Wow.
But their free cash flow margin is negative 1,055%.
Ouch. Now contrast that with Archer, who is trailing significantly with just $0.3 million in FY25 revenue.
And an eye-watering cash flow margin of negative 170,500%.
It sounds like a typo in the filings, but it's just a math quirk of having massive R&D spend divided by almost zero revenue.
Exactly. Now, if we connect this to the bigger picture,
Yep.
Joby is clearly winning the early monetization race. But Archer isn't trading on current cash flow.
No, it's trading on the future network.
The analysis report describes Archer as a high-beta binary execution play. If Archer executes its plan to scale consumer operations in 2026, the revenue gap between them and Joby will close violently.
Because civilian air taxi networks scale infinitely faster than niche military logistics contracts.
Precisely.
Let's shift focus to the 2026 catalysts, because the setup here is very bullish. Starting with the massive regulatory wins highlighted in the report.
The FAA milestones.
Right. Archer recently achieved 100% FAA acceptance of its means of compliance.
Which is huge. It means the specific testing criteria for the Midnight aircraft are officially locked in. No more regulatory ambiguity.
And on top of that, they were selected for the White House-backed eVTOL Integration Pilot Program,
which validates them at the federal infrastructure level. And we are seeing this fundamental validation translate directly into the technical market signals.
Let's talk about the chart setup for the listeners who follow the technicals.
Archer stock is breaking out of a tight, multi-month consolidation base right above $6.30.
It found its floor.
It did. And recently, we saw a 4.15% surge above the 50-day moving average on very high volume.
Which is the key indicator, right? The volume.
Absolutely. High volume on a moving average breakout is signaling a clear bearish to bullish trend reversal to algorithmic traders and market watchers. Institutional money is stepping in.
And Wall Street clearly sees the near-term upside. Consensus price targets are sitting in the $10 to $12 range.
Almost double where it is now.
Right, because the overarching narrative is finally shifting. They're moving from being viewed as a cash-burning R&D lab to a fully functional commercial air taxi operator.
And not just in the U.S. They are aggressively pushing into the UAE as well.
Yes, the dual-track launch in the United States and the United Arab Emirates.
It's a brilliant strategy.
So what does this all mean? We've covered the burn rates, the share dilution, the Joby rivalry, and the technical breakouts. But to summarize the analysis report, Archer's $4.8 billion revaluation is simply not a multiple of its current sales.
Not at all.
It is the literal price of admission to the future of urban air mobility.
And that $2 billion cash position is their ultimate moat. It guarantees they can cross that grueling regulatory finish line with the FAA while their undercapitalized competitors are just going to run out of money and starve on the vine.
Survival of the most capitalized.
Exactly. But I want to leave you with one final provocative thought to mull over on your own.
Let's hear it.
Given that Archer's survival ensures they transition into a commercial air taxi operator in the U.S. and the UAE, consider what happens next.
Once the aircraft are actually flying.
Right. Once the financial and regulatory finish lines are crossed, what happens when the next massive bottleneck becomes the physical airspace itself?
Oh, the city infrastructure.
Yes. How do the power grids of these major cities handle fleets of newly legal flying taxis needing megawatt charging? How does local air traffic control manage the deconfliction of hundreds of low-altitude flights over dense urban centers? The battle for capitalization is ending, but the war for infrastructure is just starting.
That is a fascinating problem for the next decade. Well, thank you for joining.
Don't forget to like, share, and subscribe for more.